Should you diversify globally? Hi, I'm Scott Hamilton, Certified Financial Planner. We're fee-only and fiduciaries. I have offices in Austin and Houston, and we help people plan for retirement. So the concept of, we're going to do something a little bit different today. We're going to review a deck. This is courtesy of Dimensional and our firm, and we set up this deck. And what we'd like to do is it kind of helps explain the concept of why you should diversify globally. My position is your investment strategy should be three things: broadly diversified, low cost, and global. Do not put it all in global, all are in emerging markets, but it has a place in a portfolio. Now let's go through some of the reasons why. Ultimately, what we're trying to do is to balance out the portfolio. We'll have some stocks and bonds and real estate and cash and some small cap, some large cap, some medium cap, but we also want to be diversified geographically. Okay, so that's where we're talking about today. So notice that this chart right here, this is a good chart. Diversification helps take the guesswork out of investing. And so along on the top, it's got years, 2011 through 2025, and then going down, it's got the higher returns at the top, and it goes down to lower returns. Notice it's S&P 500, Russell 2000. These are different indexes, right? Indices. And the point of this chart is it's widely distributed, widely dispersed. So you can't look at this and predict that next year I wish to be this, in the S&P 500 or in the Dow Jones REIT index. We don't know. The point is, broadly diversified solves that problem. So this talks about how widespread the U.S. market is. So let's switch over, and now let's look at the historical valuations for regions. This is the price to book. Notice that the blue line is the U.S. market. The price to book, people will say, oh, the market's overvalued, and you'll hear price to book is one of the categories. Well, that's true, it might be, but it's also been this way for a long time because maybe they're more valuable. But notice that the emerging markets and the developed markets are down here. So there's a reason to say that maybe we should invest some in here, not just in the S&P 500, not just right here. Large cap, that's, you see so many people with large cap growth stocks, and that's right there. You need to have little diversification there. So let's continue on. This right here is a great chart. I'll spend a little bit more time on this. Market concentration over time. So notice on the left, the y-axis is between 0 up to 12%, and the x-axis going across starts off with 1926 all the way to 2024 or 5. And then up here, notice it's AT&T, GM, IBM, Microsoft, Exxon, GE, Apple, NVIDIA, and Walmart. Now, notice that they each had their day in the sun. So here's kind of the IBM time frame, and it was GM and AT&T, and then Exxon, and then Apple was ruling the roost here. And then notice this company, oh yeah, purple. Oh yeah, we're going to be hearing a lot about them over the next years, NVIDIA. They came out of nowhere and they've dominated that. Now look at this. Position of total U.S. market cap for the top 1, 5, 7, and 10 stocks. Notice that the top 10 stocks take up now close to over 30%. That's when people talk about market concentration. A few companies at the top, these large, giant companies, are taking up to 30% of the U.S. market capitalization. So it's a good reason to have a wider disbursement of your investments. So not just in large cap growth. So continuing, there's a world of opportunity in equities. This is saying that the global market is, a huge number, right? And this is breaking it down between developed, emerging, and other. And the U.S. is 62% of the global market, right? China is developing in gray, emerging in gray, Taiwan and Korea, India, and the blues the developed, Switzerland, France, United Kingdom. Switzerland's 2%, France is 2%, U.S. is 62%. So the bulk of your investment should be in the U.S., but don't oversee the overseas markets. Don't overlook those. So continuing on, this is good. The S&P 500 is this blue line right here. It's got $62 trillion in it. But the Russell 3000, it's got $71 trillion. Its largest company is Spotify. The S&P 500 largest is NVIDIA. And then if you go to the MCI All World Index, this is a global index, it's $135 trillion. So it's double what the S&P 500 is. And it's got different companies in there. So again, diversification is a great way to help us. And by the way, the U.S. has rarely been at the top performing country. This is percent return over time from 72 to 25. The blue line is the U.S. index, right? And it's just saying that the U.S. is broadly where you'd expect it, in the middle, not the top, not the bottom. And this is the chart we'll end on. But this is the equity returns of developed markets. The y-axis over here, high returns at the top, all the way down to the lowest return. And then coming across this way is years, 2006 all the way to 2025. Again, this is an eye test. I love the chart because you clearly see the distribution of the returns by country. See, Spain was the best in 2025, 82%. The worst was Denmark, minus 13.5. Sweden, minus 28. UK, minus 10. Up here, Denmark was the best at 43.7. So it's a fun way to look at I love to show this to clients and say that instead of let's picking an individual country, let's buy all the countries, and we can have a component of your investments in the U.S. and in global, and we'll split it between emerging and developed countries. So bottom line is, consider investing both globally and domestically, and you'll have smoother returns with lower standard deviation over time. Anyway, thank you for watching. Visit our website, Hamilton Financial Planning, and schedule us a Get Acquainted meeting. I can send you the deck. We can talk more about any of these details that you have questions about. Thank you for watching.